Welcome to this session where we are going to do a question on group cash flow statement. And this kind of question, group cash flow statement, are usually tested in advanced financial reporting, whereby in advanced financial reporting, the kind of cash flow statement tested usually involve an acquisition of a subsidiary and a disposal of a subsidiary, but we also have the issue of investments in associate or other investment. So today we are going to do a question which was tested on in 2016, question 2, and we are first going to go through the question and then do the necessary answers. So Samaki Group Statement of comprehensive income for the year ended that 1st December 2015. Remember, when you're doing a cash flow statement, you're usually given a statement of comprehensive income or a statement of profit or loss, and then you are given two balance sheets, one for the previous year and one for the current year in which you are doing the cash flow statement. So this is the statement of comprehensive income. We have revenue 24,600 million, cost of sale 19,320 million, other income. So at other income, we have share of profit after tax from associate 249, gain on disposal of property, plant and equipment 45, interest income 141. Then we have distribution cost 2,406 million, administrative expense 110 million, finance cost 11 million, profit before tax 178 million, income tax expense 594 million, profit after tax for the year 1584 million, then attributable to parent is 1254, and attributable to NCI, that is non-controlling interest, is 330 million. So then you are given the two balance sheet or the two statement of financial position as at that 1st December 2015 and that 1st December 2014. So you have non-current asset, current asset, total asset. Then we have capital and liabilities, ordinary share premium, revaluation reserve, retained earnings, non-controlling interest, and long-term liability and current liability. So all the current liabilities have been combined together in these statements of financial position. Then you are also given a statement of changes in equity for the year ended that 1st December 2015. So you have the balance brought down. We have share capital, share premium, revaluation reserve, retained earnings. Then we have the total. So we have gain on revaluation of properties, 60 million, net profit, dividend paid, exchange difference on retranslation of foreign investment, exchange difference on loan to finance equity investment, issue of share capital, and then balance carried down. So from there, you are given additional information. Samaki Limited, so this is the parent, acquired 80% of the ordinary shares in Zebra Limited. So Zebra Limited is a subsidiary on 1st January 2015. This date is very important. The fair value, this date is very important because the statement of financial position are given as at that 1st December 2014 and that 1st December 2015, which means that in the statement of financial position under that 1st December 2014, this subsidiary is not included. So we continue. The fair value of the assets of Zebra Limited as at 1st January 2015 were as follows: So we have property, plant and equipment, inventories, trade receivable, cash and cash equivalent, trade payable, accruals, current tax, net asset. Then the purchase consideration was shillings 291 million and comprised of 6 million ordinary shares of shillings 10 per value in Samaki Limited, issued at shillings 40 each and shillings 51 million in cash. So that is the purchase consideration. Then the summary of property, plant and equipment was as follows. So we have the balance at 1st January 2015, additions including Zebra Limited, revaluation of property, plant and equipment. Then we have disposal and depreciation. Then we have balance as at 31st December 2015. There have been no sale of investment. The investment included as an non-current asset were made up of the following item as at 31st December 2015 and 2014. So investment in associate company 900 million and 660 million in 2014. Trade investment including purchase of foreign equity investment 1440 million and 150 million. Then interest receivable included in trade receivables was shillings 45 million as at 1st January 2015 and shillings 51 million as at 31st December 2015. Then current liabilities comprised the following item as at that 1st December. So you have been given a breakdown of the current liabilities here. Trade payables, including interest payable of shillings 27 million as at that 1st December 2015, was that 579 million and 2739 million. That is in 2014. Then current tax, and then we have the accruals. We continue. The exchange difference included in the statement of changes in equity relate to a transaction involving a foreign equity investment. An interest-bearing loan of shillings 900 million was obtained during the year to finance the foreign equity investment. Both amounts are after retranslation as at 31st December 2015. And then the final additional information. During the year ended that 1st December 2015, an interest-bearing loan amounting to shillings 300 million was obtained to acquire additional property, plant and equipment. The assets were acquired in the course of the year. Required. So you are required to prepare the group statement of cash flow in accordance with International Accounting Standard 7 statement of cash flows for the year ended that 1st December 2015. So in this question, I have already prepared a format to save your precious time. And if you don't believe me, let me open the format. So it is here. So when you're preparing a statement of cash flow, so we have Samaki Group Limited group statement of cash flow for the year ended that 1st December 2015. We usually start with cash flow from operating activities. And from operating activity, we start with the profit before tax. So how much was the profit before tax? So we can check that one quickly from the question. The profit before tax was 2178. So the profit before tax was 2178 million. Then we adjust for non-cash items and those items which are not operational in nature. So we adjust for non-cash item and those items which are not operational in nature. And non-cash item, they include depreciation, impairment of goodwill, and then those items which are not operational in nature, they include finance costs. So we can start with the share of profit after tax from the associate. So we deducted here. How much was it? We check the share of uh, so the share of profit after tax for the year was 249 million. So we deduct 249 million. Then the gain on disposal of property, plant, and equipment. How much was it? We can quickly check. The gain was 45 million, so we also deduct 45 million. Then interest income. Interest income. Remember, interest income usually comes from investment. So that is not an operating activity. So interest income, we also deducted, it is 141. Then depreciation. Were we given the depreciation or do we need a working? So we can check. The depreciation under the additional information, we go to the additional information. Under the additional information number 2, where you are given the summary of property, plant, and equipment, the depreciation is given. The depreciation for the year is given as 117 million. So we add back the depreciation of 117 million. Then impairment of goodwill, that one will need a working, so we can skip it. We can first skip it. That one will need a working, so let us call it working 1. Then finance cost, we add back finance cost because finance cost is not an operating activity, it is a financing activity. How much was the finance cost from our statement of comprehensive income? I can see that the finance cost was 11 million. 1 million. So we add it back. Then after adding all those items, we will get something we call profit before. We will get something we call profit before changes in working capital. So from that, after getting profit before changes in working capital, we can now go to the changes in working capital. Like we can have here the increase in inventories. So we check how much was the inventories. The inventories as at that 1st December 2015 were 400 million, and as at that 1st December 2014 it was 1,914 million. So but remember, we acquired a subsidiary called Zebra Limited. We acquired a subsidiary called Zebra Limited on 1st January 2015. So we also need to deduct that subsidiary. We also need to deduct the inventories that came with that subsidiary, which is 120 million. So So I'll take the inventories as at the end of the year. Then I deduct the inventories that came from the subsidiary, that is Zebra Limited. Then I deduct the inventory at the as at that first December 2014, which you have seen. Is it 1914? Yeah, it is 1914. So how much are we getting after doing? So 2,400 minus 120 minus 1914. So I'm getting 366. So that is an increase in inventory. So an increase in inventory we deduct because it represents a cash outflow. Then we go to the trade receivables. Under the trade receivables, I can see that the trade receivables as at that first December 2015 were 1830, and as at that first December 2014 they were 1440. But remember, in the additional information number one, in the additional information number one, in the additional information number two, you have been told that interest receivable included in trade receivable was 45 million as at 1st January 2014 and 51 million as at that 1st December 2015. So we need to deduct this interest is receivable from the respective trade receivable so that we can remain with trade receivable alone. So we take 1830 minus the trade receivable from the subsidiary. How much is the trade receivable from the subsidiary? The trade receivable from the subsidiary under additional information number one are 45 million. So we deduct 45 million and then we deduct 1440. Those were the trade receivable at the beginning of the year. But remember, out of this trade receivable as at that first December 2015, we have been told that there is interest receivable which we need to deduct from the trade receivable to remain with the trade receivable alone. How much is it? How much is it? From the additional information number two, we have been told interest receivable included in trade receivable was 45 million as at January 2015 and 51 million as at that first December 2015. So here I deduct 51 million and then from this one I deduct 45 million. So what are we getting? 1830 minus 51 minus 45 minus into bracket 1440 minus 45. I'm getting an increase of 339. So we also deduct 339 million. Then we go to increase in trade payables. So we check how much was the trade payables at the beginning of the year and at the end of the year. So from the balance sheet, all the current liabilities have been combined, but in the additional information number 3, the current liabilities have been split into their respective portion. We have and additional information number 3, we have the trade payables including interest payable of shilling 27 million as at 31st December 2015 were that 579 and 2739. That 579, so that 579, we deduct that interest payable of 27. Then we deduct the trade payables that came from the subsidiary. How much trade payables came from the subsidiary? That is from Zebra Limited. I can see the trade payables that came from the subsidiary were 48 million. So we deduct 48 million and then we deduct the trade payables at the beginning of the year. And the trade payables at the beginning of the year were 2739. 2739. So we get an increase of how much? That 579 minus 27 minus 48 minus 2739. I'm getting an increase of 765. So increase in trade payables, that is a cash inflow. Then we have the increase in accruals. So we check how much was the accruals. I can see at the additional information number 3, the accruals were 315 and 315, that is at that 1st December 2015, and 300 at that 1st December 2015. So we check, we also deduct the accruals that came from the subsidiary, and the accruals that came from the subsidiary are 12 billion. So we take 315 minus the accrual that came from the subsidiary, 12, minus the accruals at the beginning of the year, or the accruals at that 1st December 2014. So if we do that, how much are we getting as our accruals? 3. I'm getting 3, so that is a cash inflow of 3. Then we have the tax paid. Tax paid, we will need a working. So let us call it working 2. We will come to the working later. Then we go to the cash flows from investing activity. And from the investment activity, we can start with the proceed from the disposal. Proceed from the disposal, we first take we check from our question how much was the proceed from the disposal. And I can see from the analysis of the property, plant and equipment, the book value of the property, plant and equipment that was disposed was 90 million. So we write 90 million there. Then we add the gain on disposal to get the total disposal proceed. How much was the gain on disposal? We can even check it from here. The gain on disposal was 45 million. So we add 45 million to get 135 million as the total proceed from the disposal. So the total proceed from the disposal is 135 million. So that is a cash inflow. Then we have the purchase of property, plant and equipment. That one will need a working, so we can call it working 3. We need a working 3. Then net aggregate cash inflow from Zebra. On acquisition of subsidiary, how much cash did we receive and how much cash did we pay? So we come to the question and check the amount of cash that was from the subsidiary, that this is cash and cash equivalent, was 105 million. And the amount of cash that we paid to acquire the subsidiary is 51 million, because the subsidiary, the purchase consideration was 291 million, which involved 6 million ordinary shares of 10 per value in Samaki Limited at shillings 40 each. So out of this 291 million, the total purchase consideration, 51 million was cash and the rest was through the exchange of shares. So we will take the cash that came in. This is 105 million. This is the cash we received from the acquisition of subsidiary. Then we deduct the cash that we paid to acquire the subsidiary. So it is 105 minus 51. 105 minus 51. And how much are we getting? I'm getting 54. So this is the aggregate cash inflow from the acquisition of subsidiary. I'm getting 54. Then there is the cash dividend received from the associate. Cash dividend received from the associate, because an associate investment is in an associate is also an investing activity. So for that one, we will need a working. So we can call it working 4. Then purchase of trade investment. For that one, we also need a working. We can call it working 5. And then interest income. Interest income. So from the additional information number 2, we have been told that interest receivable included in trade receivable was shillings 45 million as at 1st January 2015 and shillings 51 million as at 31st December 2015. So we can say the interest receivable at the beginning of the year was 45 million. Then we add the interest income for that period. How much is the interest income? The interest income is 141 million. So we add 141 million and then we deduct the interest income as at the end of the year to get the total cash received from the interest income. So this is cash from the cash cash from interest income. So how much is it? 45 plus 141 minus 51. I'm getting 135. So the total here will be the net cash inflow or outflow from the investing activity. Then we go to the financing activity. Proceed from issue of shares. That one will need a working, so we can call it working 6. Then dividend paid by parent company. This one are given in the statement of changes in equity. So this one we will not need a working because they are given in the statement of changes in equity. How much is the dividend paid by the parent company? It is 378 million. So we just put 378 million. Dividend paid, that is a cash outflow. Then dividend paid to the NCI member, so that one will need a working, so we can call it working 7. Then cash from loan borrowed. From the last additional information, we have been told that an interest-bearing loan of Shillings 9 million was obtained during the year to finance the foreign equity investment. Then, during the year ended that 1st December 2015, an interest-bearing loan amounting to Shillings 300 million was obtained to acquire additional property, plant, and equipment. So, two loans were obtained. This one of 900 million and this one of 300 million. So, cash from the loan obtained will equals to 900 million plus the 300 million. So how much is that? Is that 12 million? Yeah, so that is 12 million. No, 1,200 million. So then interest paid we will need a working, and loan repaid we will need a working also. Then from there you can come and put in this side the cash and cash equivalent at the beginning of the period. So this one we can call it working 8, and this one we can call it working 9. Then from there you can come and put cash and cash equivalent at the beginning of the period in this column. So without any working, how many marks could you get in this question? We have remember only the entries are marked. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, and 16 of the cash equivalent at the beginning of the period. So you already have 80% without any working. You already have 80% because this question is out of 20 marks. So Let us do the workings now so that we can get all our marks. The first working we need to do is the impairment of goodwill. Impairment of goodwill. So we can come here to working 1, impairment of goodwill. We check the goodwill at that 1st December 2014. How much was the goodwill at that 1st December 2014? From the statement of financial position, I can see that the goodwill was 246 million. So we come here and put the goodwill at that 1st December 2014 was 246 million. Then we add the goodwill on acquisition of the subsidiary, that is on acquisition of Zebra. So the cost of investment was 291 million. Then the net asset acquired would be 80%. 80%. How much is the net asset that were acquired from the subsidiary, that is from Zebra Limited? From additional information number 1, the net asset acquired were 300 million. So we take 80% of 300 million. So we are using the partial method to get the goodwill because we have not been given the value of the NCI. So we multiply by 300 million. How much is it? So how much? 80% times. So I'm getting to 40 million. So how much is the additional goodwill from the acquisition of Zebra? So it is 291 minus 240. So I'm getting 51. I'm getting 51. So 246 plus 51 to get the total goodwill at 1st January 2015. So 246 plus 51, I'm getting 297. 297 as the total goodwill. Then we raise goodwill at that 1st December 2015. So how much is the goodwill at that 1st December 2015? It is 270 million. So we raise 270 million. So the impairment of goodwill is looking like it is 27 million. So we are done with that working. Impairment of goodwill here is 27 million. So we add it back. And at this point, we can get our profit before changes in working capital. So 2178 minus 249 minus 45 minus 141. We add 117, add 27, and add 111. So I'm getting my profit before changes in working capital as 1998. 1998. Then we come to changes in working capital. We needed to work working 2 for the tax paid. So we go to working 2 for the tax paid. So we check the balance of the tax that was brought down. Then we add the tax from Zebra Limited. Then we add the tax expense for the year. And then on this side, we put the balance carried down. And then the balancing figure is the cash or the tax that was paid during the year. So how much was the balance brought down of the tax? So the current tax was 600 and the balance carried down was 609. What about the tax from the this 90? So the balance brought down was 600. Then the tax from Zebra was 90. Then the tax expense for the year, we can even check that one here. No, let us check it from the statement of financial position. From the statement of financial position, the income tax expense is 594. So we put 594. If we add all of this, how much are we getting? 600 plus 90 plus 594. I'm getting 1284. Then, so here we also expect to get 1294. What about the balance carried down? The balance carried down, we have seen it is 6, or it is 609, which means that the balancing figure, which is, no, this is 1284. The balancing figure, which is 1284 minus 609. So the cash that was paid for tax is 675, 675 million. 675 million. So we come here and put it 675. So at this point, I'll get net cash inflow from operating activities. So I take 1998 minus 366 minus 339 plus 765 plus 3 minus 675. So I'm getting 1386 as net cash inflow from operating activities. Then we go to the working number 3, which is the purchase of property, plant, and equipment. Purchase of property, plant, and equipment. So we put our working 3 so that we can get the cash. So we start with the balance brought down. So the balance brought down was that 270. Then the balance carried down was 3957. So that 270. Then acquisition from Zebra. So I can we also put the balance carried down, which is 3970. Is it 3970? No, 3957. 3957. What about the acquisition from Zebra? Acquisition from Zebra, we have been given an analysis of property, plant, and equipment. Property, plant, and equipment acquired from Zebra is 180 million. So we add 180 million here. Acquisition from Zebra is 180. Then the revaluation gain is 60. What about the disposal? The disposal is 90. And then the depreciation charge for the year, the depreciation charge for the year is 117. 117. So if we balance this, 90 plus 117 plus 3957, I'm getting 4164. So also here we have 4164. So what is the balancing figure? So 4164 minus 3270 minus 180 minus 60. I'm getting 654. I'm getting 654. I needed to do this working, but also so I needed to do this working in case you meet other question in future, but you could have also said that from the analysis of from additional information number 2, from the analysis of property, plant, and equipment, the total addition for the year were 834. 834. Then 834, you could deduct the property, plant, and equipment from the subsidiary, which is 180. We are also getting 654. But I needed to do that working because of future questions. So we are getting 654. That is the cash used to purchase property, plant, and equipment. $654. Then cash dividend received from the associate. So we need an working for. How do we get the cash dividend received from the associate? We check what was the investment in the associate as at the beginning of the year. The investment in associate from this additional information number 2, investment in associate company as at that 1st December 2014 was 660, and as at that 1st December 2015 was 900. So the balance brought down of investment was 660, and the balance carried down was 900. So here we add the profit share, in associate to get the total amount of the investment. How much was the profit share in associate? I think it was 249. Yeah, it was 249. Profit share after tax, so it is 249. 249. So 249 plus 660, I'm getting 909. 909. So the balancing figure is 909 here, which means that is the cash dividend that we received from the associate. So that is the cash dividend received from the associate. So we get a 9 there. Then we go to working 5, which is the purchase of trade investment. Our working 5, the purchase of trade investment. What is the balance carried down of the trade investment? The balance carried down of the trade investment is 1440, and the balance which was brought down, that is at that 1st December 2014, was 150. So the balance carried down is 1440, and the balance brought down, which we less, was 150. But remember, there was an exchange difference. There was an exchange loss due to the purchase of investment due to the use of foreign currency. So we add back. So from the statement of changes in equity, you've given that exchange difference on retranslation of foreign investment is 615 million, which is a loss of 615 million. So we added back 615. So how much cash was used to buy those investments? So 1440 plus 615 minus 150, I'm getting 1905. 1905. So that was the cash used to purchase investment, including the purchase of trade investment in foreign currency. $1905. So if I add all of this, how much am I going to get as my net cash outflow from the investing activity? From the investing activities. So we have 135 minus 654 plus 54 plus 9 minus 1905 plus 135. So I'm getting a net cash outflow of 2226 2226 million. So from there we go to cash flow from the financing activities, proceed from the issue of shares at a premium. That one I said we need a working, so we go to our working 6. Working 6. What was the balance brought down of the share capital? We check from the statement of financial position, or we can check from the statement of retained earnings. The balance brought down of share capital was 550, sorry. So the balance brought down was 550. Then the share acquired from the Zebra, that is a subsidiary, we have been told that 6 million shares were acquired. So we take 6 million. What was the par value of these shares? The par value was 10 because the shares were at a par value of 10. Remember, any price above the par value, that becomes now the share premium. So under the share capital account, we only put the shares at their par value. So multiply by the par value, which is 10. I'm getting 60. Then what is the balance carried down of the shares? The balance carried down is 540. The balance carried down is 540. So 5. No, the balance carried down is 540. So we expect here to be 540 because 540 is the larger figure here. There, 540. So the balancing figure here on this side represents the cash received on the issue of shares, which is, so 540 minus 450 minus 60, I'm getting 30. I'm getting 30. Then, so that is the share capital account. Then we go to the share premium account. What was the balance brought down of the share premium? The balance brought down of the share premium is 45. So we put 45 here. Then the share premium from Zebra, the share that were issued were 6 million and they were issued at a price of 40. But remember, 10 shillings is the par value because the shares are at a par value of 10. So the share premium account will multiply it by 30. And if we multiply it by 30, and if you don't believe me, we can go back to the additional information. Additional information number 1, where it says that 6 million ordinary shares of shillings 10 per value. So this is the price of the per value in Samaki Limited issued at shillings 40. So to get the price of the share premium, we'll take this 40 minus this 10, which is the per value. So, and 40 minus 10 is 30. So 6 times 30, how much are we getting? 6 times 30, I'm getting 180. Then what is the balance carried down of the share in the share premium account? The balance carried down in the share premium account is 255. So 255, it looks like 255 is the bigger figure here. So 255. So the balancing figure here represents the cash on the issue of shares at premium. So 255 minus 180 minus 45, I'm getting 30. So the total cash inflow from the issue of shares, so we can, so total cash inflow from issue of shares will be equals to uh, this 30 million from share capital and this 30 million from share premium. So 30 plus 30, which we are getting 60. So we come to our statement of cash flow and write 60 here as proceeds from the issue of shares at a premium. Then dividends paid to NCI, also that one we will need a working, we'll need a working 8, a working 7. So we go to working 7. So what was the balance as at that 1st December 2014 of the NCI? Then we'll add the new NCI, that is the acquisition of Zebra Limited on 1st January 2015, and then we will add the profit attributable to NCI, and then on this side we'll get the balance carried down. So the balancing figure will represent the cash dividends paid to the NCI. So So what was the balance brought down of the NCI from our statement of financial position? The balance at that 1st December 2014 was 450 and the balance carried down was 753. So we first write those figures: 450 and the other one is 753. That is the balance carried down, 753. Then we have the new NCI acquired. So then it will be 20%. So this is the share of the NCI. 20% we multiply by the net assets acquired. So what was the amount of the net asset acquired? There were 300. Multiplied by 300. Those were the net asset acquired. So how much are we getting? So I'm getting 60 as the new NCI acquired in Zebra Limited. Then we add the profit attributable to NCI. It was 330. You can check it from the statement comprehensive income. It was 330. So if we add all of this, how much are we getting? So 450 plus 60 plus 330, it is coming to 840. So I expect here also to be 840. So the balancing figure here represents the cash dividend. So 840 minus 753, I'm getting 87 as the cash dividend paid to the NCI. So we write 87 dividend paid to the NCI. Then we go to the interest paid. The interest paid, which is working 8 now. So how much was the finance cost? The finance cost was 111. So that was the finance cost. 111. Then the balance carried down from the trade payables. From the trade payable, from the breakdown of the current liabilities under the trade payables, we have been told that trade payables, including interest payable of 27 million as at that 1st December 2015. So this represents the interest that was not paid as at that 1st December 2015. So we will need to say that the balance carried down of the interest payable was 27. So the balancing figure will now represent the interest that was actually paid. Remember, interest is paid from loan, so interest paid is under the financing activity because you take loan to finance your operations. So I'm getting 84 as the cash paid. So the interest paid is 84 million. So there 84. Then the loan repaid, we can do our working 9 to get how much was the loan, how much loan was repaid back. So the balance brought down, what was the balance brought down of the interest bearing loan from our statement of financial position? The balance brought down was that 180 and the balance carried down was 4194. So this is the interest bearing borrowings. the balance brought down was that 180, and the balance carried down was, is it 4194? Yeah, the balance carried down was 4194. But remember, there was a loan which was borrowed to finance the foreign equity investment amounting to 900 million. And there was another loan which was borrowed to acquire additional property, plant, and equipment amounting to how much? It amounted to 300 million. And there was a gain on translation of this loan uh, which was borrowed to acquire additional property, plant, and equipment. How much was the gain? We can check from the statement of changes in equity here. The exchange difference on loan to finance equity investment was 30 million, a gain of 30 million. So we deducted from our loan because that gain did not involve cash, 30 million. So after deducting it, and if we deduct that and deduct the balance card down, we are going to get the amount of the loan which was repaid. So that 180 plus 900 plus 300, so 4380, that was the total amount of loan. We minus the gain on translation, which is 30, and then we minus 4194. So the amount of loan repaid is coming to 156 million. So we go to our statement of cash flow and put 156 million. So that is the loan repaid. So it is a cash outflow. So if we add all of these, we are going to get net cash inflow from the financing activities. So 60 plus 60 minus 378 minus 87 plus 1200 minus 84 minus 156. I'm getting 555. So I'm getting 555 as the net cash inflow from the financing activities. So if we add all of these, we are going to get the decrease or increase in cash and cash equivalent for the period. So 1386 minus 2226 plus 555, I'm getting a decrease in cash and cash equivalent of 285 for the period. So that is the decrease in cash and cash equivalent for the period. And then what was the amount of cash and cash equivalent at the beginning of the period? You can check that from the statement of financial position. The cash and cash equivalent at the beginning of period were 420, and at the end of the period were 135. So we earned 420, and if we get 135, we know that our answer is correct. What is negative 285 plus 420? I'm getting 135. So that is how you go about this question of group cash flow statement in the advanced financial reporting. So thank you very much. And if you have any question, then you can ask in the comment section below.